Hey, it's Chris Byer.
Chris Bowling.
Hey, CB, we've got a guest this morning, Tyler Horbach. Welcome, Tyler.
Awesome.
One of our
morning.
team members with AP.
Thanks for
Tell
having
us who you are, Tyler. What's your background? What do you do for Assured Partners?
Sure. Yeah, my name's Tyler Horbach. Like you mentioned, with Assured Partners. I'm the regional specialist for individual life insurance and executive benefits.
Yeah.
And as far as a very quick background, I've been in the industry for 9 years. Started with Principal Financial, where I was an internal wholesaler and worked with folks such as yourselves, and in my role now, working with primarily with business owners and executives, and then high net worth individuals on the corporate side, their benefits and their business succession strategies. Gotcha. A lot of farm families with estate equalization strategies, partnering with attorneys and CPAs, making sure we have a tax and legal efficient plan that dovetails all together for their families and organizations. So back in 2020, joined with Assured Partners. So I was a COVID hire. I think they just had an open office. So they said, hey, Tyler, why don't you come over here?
Let's fill out with this guy.
Yep. But in all honesty, I was, in the corporate world and wanted to actually get out in the field like you all were and are, and do this at kitchen tables and in boardrooms. So been a great ride so far, and looking forward to a long-term career here.
Yes.
So I know we've had you meet with several of our benefits clients to talk through these different topics. And, I think you would agree that the concept of executive benefits or key person insurance is somewhat misunderstood in the marketplace. It almost gets lumped into one concept. And, my question would be, number one, what is that? And why should a business owner or an organization start thinking about those topics?
Sure. Well, great question. A few things as far as what key person insurance is. And it's like going to a car dealership, name the brand, Ford, Chevy, Toyota, and saying, hey, I want to buy a vehicle. Well, okay. Do you care about gas mileage? Do you tow anything heavy? Do you need 4-wheel drive? So you kind of go into this maze, probably a bad example, but it's the best thing I had off the cuff.
No, it works.
to navigate what buying a vehicle is. Well, same thing with key person insurance. I'm just going to boil that down and just bare bones. It's a plan or coverage an organization acquires to mitigate three main risks. I call them the 3 Ds: death, disability, and departure. Death and disability you can obviously buy insurance for. Departure, to my knowledge, you can't go buy a product and ask for a $500,000 benefit if your top executive leaves. That's just not something you can do. But you can leverage insurance in a plan to help retain those people. That's sometimes called a golden handcuff plan. As far as why people should start thinking, well, I'll go into just really, going from what it is to the most popular solutions that I see with key person insurance.
That would be good.
And stop me at any time, by the way. I'm really good at talking. So stop me again if you need me to take a break here. So first off, I would say key person term and disability is the most popular from a volume standpoint as far as number of policies. That's where, let's say people want to fund their buy-sell agreement. Even if it's a single owner organization, there should be a buy-sell agreement of some sort. So if that owner can't come into work tomorrow, what happens with that ownership? The term or disability policy will fund their ownership if again, they pass away or become disabled. Most common scenario, let's say you got a $10 million business, 2 owners, 50-50, one owner passes away. Hopefully both owners have a $5 million policy that will buy out that ownership. That way the other owner doesn't have to go take out a loan or pull other financial assets out of the business to buy out the heirs, and maybe keep people that you want to be financially whole but shouldn't be a part of the business,
Right.
Yeah. Because you would probably say that a lot of partnerships, they don't involve the entire family. So it's business partner, but you've got spouse, children that you maybe don't want to have, or they have no interest in being in the business.
Right. And then also just your like CEOs or doctors or people that are responsible for a large portion of the revenue to the company. So if you have a doc that goes down and he or she's responsible for $3 million of revenue per year, it'd take you 2 years to maybe hire and train an adequate replacement. You're looking at 3 million times 2 years, $6 million potentially of lost income.
Right.
So those are very common. And I'm not going to go too far in the weeds as far as plans and underwriting and stuff, because there's programs where we can bypass the traditional underwriting aspect, which is becoming much more popular. So that's first, key person term disability. Second would be executive life and disability. Okay. So this is where, again, an oversimplified example, an organization has an additional perk goes to the executive class and says, hey, our core benefits, our core group life, group disability, let's just use disability as an example, covers everyone at 60% up to a max dollar amount per month.
Yes.
Obviously, folks making over X, your income's replaced at 45% or 20%. Right. Let's stack something on top of that so that should you become disabled, you're protected at the same rate as everyone else in the organization.
Yeah.
Yeah.
Same thing with life insurance. Your
Right.
group life is maxed out at this. Well, we'll pay you for you to have this.
I think that's been something we've noticed more, Tyler, too, with incomes rising here in the last year with inflation and wage pressures, that people need to take a look, first of all, at their total group disability to make sure that that's adequately covering everyone. But certainly you don't want that executive to go down and then find out that after the fact that they weren't covered and they were expecting that income. Yeah.
Right.
That's a good point.
For sure. And the third category, which is probably the most murky, if you will, are the deferred comp, golden handcuff plans. And I'm not going to bore you with the knowledge, but common phrases you'll hear are single bonus, double bonus, executive bonus, stay bonus, loan split dollar, select reward, SERP, endorsement split dollar. There's just so much to navigate there. And really it comes down to, and I'll talk about a few of those, the ones I see most common, but it really boils down to what are the goals of the organization? That's a no-brainer. Yes. The entity, so are you a C Corp or are you a pass-through entity like an S or a C Corp?
Right.
And are you a nonprofit or a for-profit? Because there's definitely some plans that are better for for-profits and better for nonprofits. Okay. And I'll get into that a little bit. And I'll do a quick shameless plug, not for me, but for our team at Assured Partners, that this is a pretty complex area to navigate. So if someone has a life or health insurance license, nothing against them, but it takes it takes a team to be able to set up these plans correctly. They can be set up, with help of a carrier, but then what's going to happen 5 years down the road, 10 years down the road, when it comes to fulfilling this promise, you need to have a team that really has experience in executing on the plan. And I'm not going to say we're the best, because I think once someone says they're the best, they're going to be humbled pretty quickly. But I will say I will put the team and resources that we have in our bench strength to implement a plan for you that would be very advantageous, and we can go up against anybody, in my opinion.
That's exactly why we have you on here, is that we get those questions from those experts, and we don't want them to be.
Well, I've learned
it's just figuring out what, like we do with all of our clients. It doesn't really matter the insurance carrier or the exact product. It's how are we fulfilling that strategy that we've set forth with the client, because anybody can sell the policy. Does it actually work for the intended purpose? Right. And again, that's not a plug for me. I've just learned to surround myself with very smart people. So to be clear on that.
Amen.
It's a good technique.
Yeah. So really quick, I'll touch on a couple here. You talk about what business owners are doing, seeing, and challenges they're facing. And this is, widely known. Just watch the news and you'll see, obviously, inflation's going up. And I'm going to use words that people are going to roll their eyes because they hear them so much. Inflation's going up, wages are going up, the cost of business is going up. And, businesses are, I wouldn't say struggling, but they're definitely not the 2020, 2021 where just flushed with cash and, we can afford to give these increases. So what I'm seeing more and more are folks implementing several strategies, but one in particular called a select reward plan. And what a select reward plan is where, let's say, I go to Chris Bowling and let's say inflation's up 8%. So obviously Chris is wanting his raise to be 8% to keep track, right? But we also just don't want to keep throwing out raises every year. So what I would say is Chris, you're a vital part to the organization, and I want to award you correctly, or to keep track with the rising cost of living. Instead of giving you an 8% raise today, how about this? I'm going to give you a 10% raise. But what we're going to do is have this as in form of a deferred compensation plan or select reward plan, where I will put, let's say, Chris, you're making $200,000. I'm going to put $20,000 a year into this plan. It's an asset we own. It's a corporate-owned life insurance policy. And we're going to put $20,000 a year in for 10 years. And at the end of these 10 years, assuming you satisfy a vesting schedule, you don't go work for a competitor, you will get this, whatever that account grows to, you will get that in form of a bonus. And
I like that. Yeah.
what people like about that is, so the organization is not giving, if it's nothing wrong with giving up ownership, but some people don't want to give stock in the company to keep
Right.
people in the form
Yep,
of
makes
raises.
sense.
So you don't have to give up ownership. You're not giving raises, because you give him a raise today and next year he goes and works at competitor ABC. And if he leaves, so you keep that 10%. If he leaves, that's an asset on the books, your organization, that is, he gets none of that. You've got the death benefit protection, where if he does pass away, then the organization gets those funds tax-free. When that bonus is paid, the organization gets a tax deduction in that amount. So let's just say it grew to $500,000. I'm just making that number up. At that time, the organization would deduct $500,000 from their taxes, which is key because, very quick segue, the Tax Cuts and Jobs Act is going to sunset after 25. So basically January 2026. So corporate tax rates are going to go up unless they pass a law to change that, which we know how, this is not political. We know that getting a law passed is
It takes some work now.
is pretty difficult. So the odds of corporate tax rates going back up are pretty good. So they're again getting a deduction when tax rates theoretically are going to be higher. Also, I shouldn't say a little known fact, but some people aren't aware that life insurance is taxed the same way as a Roth IRA. So post-tax dollars go in, that grows tax deferred, and then income is accessed tax-free. And that matters because, folks, and I need to find in my notes here. So for 2023, the most someone can contribute if they're under 50 to a Roth IRA is $6,500 a year, which is not a lot if you're obviously a highly compensated individual. And if you make over $228,000 a year as a married filing jointly couple, your modified AGI, you can't even contribute to a Roth IRA. Yeah. So this is the rich man's Roth, if you will.
Makes sense.
To get past that. But anyway, I rambled really quite a bit there, I guess. Are there any questions that you guys have, or I can go on some other items that I'm seeing?
Unfortunately, we are out of time.
Okay. Okay.
No, all good. We appreciate just sharing some of that too, because I think the topic needs to be considered by every organization, regardless of tax status, regardless of ownership structure, just to have these conversations. So I appreciate sharing some of that insight with us.
Yes. Thank
you. Betcha.
Good
Thanks for having me.
We'll see you.
Take care.